Hey, what's up, my friends? So, welcome to today's presentation where you'll discover how to beat the stock markets, in less than 30 minutes a day without getting killed in a bear market or a recession. And the title of today's presentation is called Stock Trading Secrets. So, let's get started. So, here's what you'll learn, right, in this presentation. Secret number one, the easiest way to make money from the stock markets, and it's not what you think. Secret number two, how to instantly improve your returns and reduce your risk using this one simple technique that not many traders are aware of. Secret number three, a simple stock trading strategy that works without getting you killed in a bear market or a recession. And finally, secret number four, I'm really excited for this one, how to scan for profitable stock trading opportunities in less than 30 minutes a day without paying for a stock scanner or a subscription service. Sounds good? Let's get started. So, when it comes to stock trading, you pretty much have one of two options. You can either, number one, buy low and sell high, or buy high and sell higher. So now the question is, which approach is better? So number one, what we're going to do is we're going to run a simple backtest across the US stock markets and let the data, speak for itself. And to do this backtest, the first one we'll do is to buy low and sell high. So the first rule is this, right? We'll go long when the stock hits a 50-week low. So what do I mean by when the stock hits a 50-week low? So I'm just going to draw a simple thing out. So for example, let's say the stock is declining down lower, and lower, and then it hits this price point. Let's say this price point is the 50-week low. Some of you might be wondering, hey, Rayner, what is 50-week low? It simply means, right, that the current stock price is the lowest price over the last 50 weeks. Simple as that. The lowest stock price over the last 50 weeks. So that's what we mean by we go long, we buy a stock when the price of a stock hits a 50-week low. So moving on, our exit rule is a 20% trailing stop loss. So again, let me illustrate what this means. So let's say a stock goes down lower, and it hits a 50-week low at this price point. Let's say this price point is at $100. Okay. So how does this 20% trailing stop loss comes into play? Very simple. If this is at $100, our 20% trailing stop loss means, right, our stop loss is 20% of this value. So clearly, right, 20% of $100 is $20. So if the price drops another $20, let's say it drops down to this point, which is $80 over here. Okay, this means that we will exit the trade. So let's put it across. We will exit the trade when it drops to $80. So from $100 to $80 is a 20% drop in price. We will then exit this trade. Now, what if, okay, let me just do with you another variation of the example. Let's say the price goes down lower to the 50-week low. You buy over here, and then you catch the bottom. The price heads up higher now. And right now, let's say initially you got it, it was at $100. Okay. And now the price has bounced up to a high of $200. So how does this 20% trailing stop loss work? Same concept, right? What we'll do is we'll take the highest price point that the stock has went to and calculate 20% of that value. So 20% of $200 is $40. So if the price of the stock were to drop $40 from the highs right now, let's say this is a $160 price point. Let's say the stock were to drop, right, from $200 down all the way down to this price point at $160. It means our 20% trailing stop loss is hit and we'll exit the trade. So this is pretty much the two ways the stock can go. If it drops down lower and hits our 20% trailing stop loss, or it goes up higher, then it reverses and then hits our trailing stop loss. Okay, so this is what this means. So the next rule to share with you is this. Sometimes when a stock, right, all of them drop at the same time, right, there are many stocks to choose from. So how do we filter the stocks to choose? So what we'll do is we'll pick the top 20 stocks that has the largest price decline over the last 50 weeks. So in essence, what we're trying to do is we are trying to buy the weakest of the weakest stocks, right, whenever it hits the 50-week low. Okay, and we have 20 positions at most. So some parameters to make the backtest more real. Our transaction cost is 1 cent per share, which is highly achievable when you're trading the US stock markets. We will test this all only in the US Russell 1000 stocks, the largest 1000 stocks in the US. We will execute the trade at the market open when the market opens. Our position size is 5%. So let me explain what this means. So unlike our traditional, 5% stop loss, right? What this one means is that let's say you have a capital of $100,000. So a 5% position size means that each stock will not be more than $5,000. Okay, let's call it 5K. So this is what we mean. So let me repeat once again. If let's say you have a capital of $100,000, the position size 5% means, right, that each stock that you buy, the value cannot exceed more than $5,000. So let's say you want to buy stock A. Okay, let's say the stock A. Let's call it stock A. And stock A, the current stock price of stock A is at $5,000. So how many shares of stock A can you buy? The answer is 1. Because remember, our value of each stock cannot exceed $5,000 if we want to make sure that our position size remains 5% of our total account value. So now, let's say what if we have stock B? And this time around, stock B, the share price of stock B is $500. How many shares of stock B can we buy? We can buy, okay, let's change this to B. We can buy 10 shares because 10 multiplied by 500 is equals to $5,000. So this is what we mean by, position size 5%. And by doing this, right, we won't allow any one stock, right, to kind of be holding too much weight in our portfolio. So for example, if you buy 10 shares of Amazon and you compare with 10 shares of McDonald's, it's not going to be equal because the price of Amazon is so much higher than McDonald's. So if you buy 10 shares of Amazon, right, your portfolio weightage will be more leaning towards Amazon than, McDonald's. So this is what we're trying to, overcome over here. We want our portfolio to be equally distributed among, these 20 stocks out there. Okay, so this is what I mean by position size 5%. And then moving on, our back test period is from 1990 to 2018. So that's about 29 years, taking into account the financial crisis, dot-com bubble, etc. So you can see over here the results of the buy low and sell high. Number of trades you have taken over the last 29 years is 467. Winning rate is about 43.68%. Annual return is about 9.28% with a maximum drawdown of 52.27%. So let me break down these numbers for you, as some of you might not be familiar with it. So as number of trades, as a winning rate. Annual return, how do we define this annual return? So very simple. Let's say you have a starting capital of $100 and let's say your annual return is 10%. So you made 10%. So $100 you add on 10% will give you $110, an increase of 10%. So let's say you make another 10% in year 2, this value now becomes not 120, but $121 because we're taking 10% of this second year value. So the 10% of this 110 is $11. $11 plus $110 gives you $121. So over these 2 years, right, we have an annual return of 10%. So what this number means is the annual compounded return, right, over the last 29 years is about 9.28%. So maximum drawdown, what does maximum drawdown mean? It's very simple. So let's say you have a portfolio value of $100,000. When you have a maximum drawdown of 52%, let's make it simple, 50%, it means that $100,000 at one point in time was only worth $50,000. That is what we mean by having a drawdown of 50%. So in this case, a maximum drawdown of 52%, it means that your $100,000 at one point in time was only worth $48,000. So this is what we mean by maximum drawdown. So this is the results of buy low and sell high. So now let's move on and have a look at buy high and sell higher. How much of a difference would that make? Would it be better or would it be worse? So again, we'll go long when the stock hits a 50-week high. So this is now the opposite. Previously, we were trying to buy when the stock price fell. So now we're trying to buy when the stock price goes up. So let's say stock is in an uptrend and it breaks out of the 50-week high, we buy. Okay, so now you can see that this is the inverse, right, of what we did earlier. Next thing, we have a 20% trailing stop loss exits. So it's again the same concept which I shared with you earlier. So I'll just briefly do this. If you buy at, let's say, a 50-week high, let's say the price is at $100, right? If it drops 20% to $80, you exit the trade. But what if it continues to go up higher? Let's say now it goes up to $300. Where is our trailing stop loss now? Simple, 20%. So 20% of $300 is $60. 300 minus $60 is $240. So if the price now reverse to, let's say, $240 at this point, okay, it will exit the trade. I'll put it across over here. It means you'll hit your trailing stop loss and exit the trade at $240. It's a bit messy, but you get my point. So that's what we mean by the trailing stop loss. And again, sometimes, right, in bull market, many stocks will hit their 50-week high at the same time. So which do we pick? We simply pick the strongest one, the top 20 stocks which has increased the most in price over the last 50 weeks. Simple. This is how we kind of filter down, which are the strongest stocks to pick. So again, transaction cost, test universe, market open, all the same as earlier. And here are the results. Number of trades. Now, the one in bracket or parentheses, right? This is actually the results from the previous backtest, the buy low, sell high. So the current results is the one bolded over here. So you can see for buy high, sell higher, you have taken 707 trades.
compared to 467 earlier. Winning rate has increased slightly to 48.66% compared to 43.68% earlier. Annual return has increased to 12.81% compared to 9.28% for the buy low, sell high backtest earlier. Maximum drawdown has been reduced to 40.75% compared to 52.27% for the earlier backtest. So you can see that at this point in time, the buy high, sell higher, right, seems to be, a better trading approach when it comes to stock trading. So if you want to see the table of results, right, this is pretty much the results on a month-to-month, year-to-year basis over the last 29 years over here. Okay, so I won't recommend you trade this on its own, but you can see that clearly this thing to share with you is it's easier, right, to make money buying stocks in an uptrend, not in a downtrend. So this is the first secret that I want to share with you. Second secret, how to instantly, right, increase your returns and reduce your risk. So here's the thing, right? Many traders think that, Rayner, to increase your returns, you have to increase your risk. Well, not quite, right? Because I'm going to share with you this very simple technique to actually, increase your returns while reducing your risk. So to do that, right, I'm going to share with you this picture of the sea, the ocean, whatever you want to call it. And because the secret lies in this image over here, can you figure what it is? So let me share with you. It's actually quite simple because out there in the sea, when the sea tide goes up, the ships in the sea goes up as well. Right? It's common sense, right? When the tide goes up, the ships goes up. When the tide goes down, when the sea levels go down, the ships which are on the water goes down as well. So what has this got to do with stock trading? Simple. You can imagine the sea. I'm just going to draw. You can imagine this on the sea over here as the market. And you can imagine all these little ships over here, ships, as individual stocks. So if the market is bullish, it's going up higher, stocks tend to go up as well. And if the market is in a recession, it's in a bear market, all these individual stocks tend to go down with it as well. So as a stock trader who wants to put the odds in your favor, you want to be only trading when the market is bullish. How do you do that? Simple. Let me share with you this technique. This is what we call a trend filter. I didn't come up with it, right? If you follow any trend following books, like, books from Andreas, Kleno, Nick Rech, etc., this is a concept they have, shared. And I'm just, learning from this, great traders way ahead of me. So how you can use this trend filter for your own trading is, again, depending which markets you're trading. If you trade US stocks, you can refer to the Russell 3000, which is simply the largest 3000 stocks in the US stock markets, or the S&P 500. It's up to you. If you trade Singapore stocks, you can refer to the STI, Straits Times Index. If you trade the Philippine stock markets, you can refer to the PSE. Okay, so how do we use this trend filter? So first and foremost, right, let me just kind of, prove it to you, right, how a trend filter can improve your trading results. So let's do a back test again, but this time around, we apply a trend filter with it. So again, the rules are the same, but we will apply a trend filter. So we will only buy if the Russell 3000 index is above the 100-week moving average, or else we stay in cash. So this is to help us define, right, hey, is the broad-based market in an uptrend or a downtrend? So we will use the Russell 3000 index. In this case, you can use the S&P 500, you can use the Russell 1000, it's up to you. I'm just going with the Russell 3000 index. And since if it's above the 100-week moving average, we will say that, hey, the overall market is bullish, let's look for some buying opportunities. But if the Russell 3000 index is below the 100-week moving average, we will say that, hey, this market is bearish, will remain in cash. So again, the rules are the same. We go long when the stock hits a 50-week high. Our exit rule is a 20% trailing stop loss. And our filter is, again, sometimes there are too many stocks to buy in a bull market. We just simply choose the top 20 stocks that has increased the most in price over the last 50 weeks. So let's have a look at the results. Number of trades, right? So, okay, let me just walk you through. 905, the one in bold, is this current backtest, right? Buy high, sell higher with trend filter. The one in parentheses in bracket is referring to the previous backtest, which is the buy high and sell higher. So in this case, we have more number of trades, 905. Our winning rate has increased slightly to 49.17%. Previously, it was 48.66%. Our annual return has further increased to 15.7%. Previously, it was 12.8%. Maximum drawdown has been now reduced to 35.08%. Previously, it was 40.75%. And if you look at the table, the month-on-month, year-on-year results, you can see that this results is really looking much better than what we have seen earlier. So yes, we have losing years along the way, but these losing years now have become more manageable. And if with a little bit of tweaking, we can even make this into a quantitative trading system. But that's a topic for another day. So the secret number 2 that I want to share with you is that a trend filter can improve your returns and reduce your risk. And I'll show you later how you can actually apply this concept to your trading and get results with it. So now moving on. All right, I want to share with you a simple stock trading strategy, right, that works without getting killed in a bear market or a recession. And the best part of it is that this strategy will be based, right, on the 3 secrets, the 3 principles, the 3 concepts that I've just shared with you. So let's get started. So the first thing to look for is trend. So when it comes to stock trading, you really just want to focus on trading trending markets. Why is that? It's simple, right? As you've seen earlier, it's much easier to buy, or rather to make money when the stock is in an uptrend than in a downtrend. So why do you want to fight this natural phenomenon of the stock markets? Why not just focus only on stocks which are in an uptrend? Even range stock markets, just forget about it. Just focus only on stocks which are in an uptrend. And because there are so many thousand stocks out there, you can just simply focus on the best trending stocks out there. And I'll share with you later how to do that. Okay, so first thing first, trend. What trend does is that it tells you what to do. If the market is in an uptrend, you look for buying opportunities. If the market is in a downtrend, then you just stay out of the markets. So how do you do this? So first thing first, stock market index above the 100-week moving average. So what this does is that it tells you what the overall market is doing. Is the overall market in an uptrend or is it in a downtrend? Next thing, you want the stock to be above the 200-day moving average. This tells you what the individual stock is doing. So remember the sea and the ship analogy I shared with you. So the stock market index is like the sea, and the stock, right, is like the individual ship. So when the stock market index is in an uptrend, when the individual stock is in an uptrend, when you trade, you have a much higher probability of success. So let me share with you how this would work. Okay, so let me just go through the charts. Russell 3000. Let's go to the weekly time frame. So remember, we want the Russell 3000, the stock market index, to be above the 100-week moving average. So in this case, we use the Russell 3000. So I'm just going to go back to the charts and change these settings to 100. Okay, and I'm just going to release this. So you can see that the black line over here is the 100-week moving average. So right now, the Russell 3000 clearly is above the 100-week moving average. So this means is that the overall market is bullish and we can look for potential buying opportunities. But we don't want to just randomly buy stocks. We only want to buy stocks which are in an uptrend. So what we will do is we will then make sure individual stocks are above their 200-day moving average. And how do you do that? Very simple. Go back to the charts. In this case, I'm going to the daily time frame. I will change this to 200. Click OK. And let's look at this Kirkland. Right, you can see that this stock right now, it's above the 200-day moving average. This stock is trading here and the 200-day moving average is here. It's above it. So this stock right now is in an uptrend. Another one. How about APPS? Digital Turbine, right? You can see that this stock is above the 200-day moving average as well. So this is what we're actually looking for. Overall market to be bullish and individual stocks to be bullish as well. And the parameters that we use, again, is a 100-week moving average for the stock market index and 200-day moving average for the individual stock. So next thing, right? So really, if you look at this, right, you can look at this. A simple analogy to give you is let's say you like a girl, right? I think most of you here are guys, right? So if you like a girl and the girl loves baking, cupcakes, scones, etc. And let's say you're interested in her. What are the odds of her being interested in you? If let's say you also like to bake, then clearly the odds are with you, right? Because of similar interests, right? Because you guys are having similar interests. You guys are having interest in the same direction. She likes baking, you like baking. Hey, there's a good chance of things working out. So same thing as the markets, right? If market is in an uptrend, you're looking to buy stocks in an uptrend, there's a good chance of things working out as well. So now this is for trend, right? Next one, just because the market or stock is in an uptrend doesn't mean you want to blindly hit the buy button, because there's another thing that you want to look for, and it's what we call area of value. So area of value, in essence, right, it tells you where to buy. So trend tells you what to do, to look for buying opportunities or to stay out. Area of value tells you where exactly to buy, because you don't want to just blindly buy when a stock is in an uptrend. It could be overextended. It could be about to make a reversal. It could be about to make a pullback. So area of value is where you want to trade from. So this could be things like support, swing low, 50-day moving average. So these are really the three things I pay attention to when I trade stocks, right? Whether the stock is at support, is it at the 50-day moving average, or at the swing low. So let me give you an example. So if stock is in an uptrend, okay, stock is in an uptrend, then what you want to look for is for the market to pull back possibly to this swing low or this area of support. This is what we mean by the area of value. So this is really what we are looking for. This is an example of an area of value at a swing low or support. It could also be area of value using the 50-day moving average, especially in healthy trends. So let's say market or stock is in an uptrend, and when you overlay with the 50-day moving average, you find that this stock tends to respect the 50-day moving average. So this is another area of value that you can look to trade from. So now let's have a look at a few chart examples so you can see what I mean. So first one is this one here, Grow Generation Corporation. So you can see over here, we have this area of value over here. I'm just going to get this tool and to highlight out. Okay, rectangle. Okay, we have this area of support over here. This is an area of value. In this case, Vox also have this area of value over here. And on top of it, I believe the 50-day moving average is also acting as an area of value for this. Okay, not quite. It actually broke down recently. Okay, so in this case, this is this area of support, right? Is an area of value for this stock right now, and this is where you want to be looking to trade from. So again, you can look at it this way, right? Just because the stock is in an uptrend doesn't mean you want to blindly hit the buy button. Okay, and with that said, let's kind of find out what is the next step. So I'm just going to get rid of the drawing. So the third thing to look for is once the stock is trending higher, once the stock is at an area of value, the third thing you want to look for is an entry trigger. What is the thing that will get you into a trade? So we call this an entry trigger. And for trading, right, entry trigger, in essence, right, tells you when to buy. Okay, when to buy. So if you think about this, the trend tells you what to do. Should I be buying right now or should I be selling? The area of value tells you where to buy. The entry trigger tells you when to buy, the exact time when to buy. Okay, and to do this, right, you can actually look at candlestick patterns. It's actually a very useful tool, right, to help you define your entry trigger. So I'm going to walk you through some basic, simple candlestick patterns that you will encounter in your trading. First one is hammer. A very common pattern. You might even heard of it before, but for those of you that have not, right, I will just explain what this means. So a hammer simply means, right, that for the day, this market has opened at this price. Let's call it O. And then at the start of the day, the sellers were in control. They came in and they pushed the price down lower, all the way down, all the way down near the lows of this day. And then the buyers look at it, they were, saying, hold up, right? That's enough, right? That's as far as you're going to push, right? Now we're in charge and we're going to push the price up higher. So they reverse all the selling that has occurred in the early part of the day, and the buyers push the price up higher. At this point, they decided, no, hey, let's inject some steroids and push it up further. So they push up even higher and close finally near the highs of the day. So you can see that the story behind the hammer is that at the early part of the day, the sellers were in control. They pushed the price down low. And then the buyers stepped in, right, and reversed all the earlier losses and closed higher for the day. So you can see that momentarily, the buyers are in control because they have overwhelmed, right, the earlier selling pressure. So this is what, in essence, the hammer is about. The other pattern to know is what we call the bullish engulfing pattern. And really, it's a very similar concept. The only difference is that it's happening over 2 days. So the first day, bullish engulfing pattern, you can see priced open over here, and then it closed near the lows of the day. So the sellers were, woohoo, right? Time to celebrate, right? This is good news, right? The market is going to collapse. And then next day, somehow the buyers, step in, maybe they took an overdose of, steroids, and they pretty much, push the price up near the highs, even above the highs of the previous day, and the buyers took control and closed near the highs of the second day, and the highs of the second day is way above the highs of the previous down day. So in essence, you can see that again, these two patterns, in essence, what it's telling you is that the buyers have stepped in and pushed the price up higher. It has rejected lower prices, right? This is in essence what this two candlestick patterns is telling you. It has rejected lower prices, rejection of lower prices. And of course, one thing to point out is when you study candlestick patterns, it's very important to understand the concept, the meaning behind it. Because when you trade, right, the markets, there are so many variations to it. And you will see later when I give you, more chart examples that, sometimes it might not happen in the form of a hammer or a bullish engulfing pattern. But remember, the key thing that we are trying to look for is rejection of lower prices. We want to see the price come down lower and quickly get rejected and close up higher. That's really what we are looking for. Okay. And So with that said, now that you've understand some basic candlestick patterns, right? The next thing to look for is your exits, right? So now you know when to enter using entry triggers. So now the final part of the equation is exit. When do you exit the trade? So when it comes to exit, right, it tells you in essence, right, when to sell, right? That's a very important thing that you have to cover. You can't just, think, oh, when to buy, because there will be times, often many times, where the market moves against you, and you can't just pray to whoever you believe in and hope the market will reverse from there. No, that's not how it works. You have to have a predefined plan to know when to cut your loss, to exit, right, if the market goes against you. And of course, if the market moves in your favor, you will also need to know when to exit your trade to book your profits. You can't just, hope the market goes to the moon, because, what you can see is that market can go to the moon and then come back to earth and you feel like crap because, you didn't take profits. So exit, right, is two part: when to cut your loss and when to take your profits. So to do that, right, let's first talk about the stop loss part. So when it comes to stop loss, right, your stop loss should be at a level, right, which invalidates your trading setup. So what do I mean by that? So whenever you put on a trade, whether it's stock trading, forex trading, crypto trading, it always have to have like a hypothesis behind it. So let me give you an example. So let's say you're looking to buy at support. Stock is in an uptrend, okay? Retest support, and you look to price bounce up higher, and you look to buy over here. So let me ask you, right, at this point, right, at where, right, will your trading setup get invalidated? At what point, right, will this area of support break down? And if you think about this, right, support is likely to break down possibly at this price point, because if right now the market breaks here, it has broke below support, and this support has now been invalidated, and you want to get out of the trade because support is broken. So when you set your stop loss, it must be at a level which invalidates your trading setup, whether you're using trend line, support, or whatsoever. So this is what we mean by at a level which invalidates your trading setup. Or let me give you another example. Let's say we are dealing with, some of you might be familiar with chart patterns. Let's say head and shoulders pattern like this. Okay, price breaks below support, breaks below the neckline. So at which part, right, at which level on the chart, right, will this head and shoulders pattern be invalidated? Okay, so if you ask me, right, depending on how conservative or aggressive you want to be, if you really want this pattern to be invalidated, your stop loss should go above this extreme high, possibly somewhere over here. Because if the price now breaks down and goes back up higher, clearly this head and shoulders pattern has failed, right? Because no head and shoulders pattern, right, should have the price, breaking out above the head, at some point in the future. So that means the pattern has failed and you want to exit the trade. So this is what we mean by having a stop loss, right, at a level which invalidates your trading setup. Okay, next one. Let's talk about take profit, right? Where do you take profit? Well, you want to take profit before opposing pressure steps in. So there are different ways you can take profit. You can, look to ride a trend in stock markets, or you can look to capture a swing. But for the sake of today's presentation, I'll just go with swing trading, because that's an approach that I believe most traders will benefit from. So how do you become a swing trader? So swing trading, right, in essence, what you want to do is to capture one swing in the market, and you want to capture that one swing before opposing pressure steps in. Like, for example, if I can't think of any example now, but let's say, this is a chart. Okay, let's say you buy near the lows of support. Okay, you buy near the lows of support. The price heads up higher. So where will opposing pressure steps in, assuming that this market is in a range? Well, if you ask me, opposing pressure is likely to step in at resistance, right? Because, resistance is an area where sellers might come in to short the market. So if you want to take profits, it might be prudent to exit right before this sellers come in, to take profit before resistance. Don't look to take profit, above the highs of resistance or at resistance itself, because remember, support, resistance, they are an area on the chart. There's a good possibility that the price might not reach the highs of resistance before, reversing down lower. And if you set your target above the highs of resistance, you're just, putting the odds against you. Okay, so we will look at this later in more details as well. So with that said, let's have a look at a few chart example, right, to the things that we have just covered. So if you look at this chart over here, this is Fiverr. Okay, you can see that over here, let's say you were to be buying, let's say the market has rallied from this swing low. Over here, it's rallied higher, and you're looking to buy. So where do you set your stop loss? At what point will this area of support be invalidated? So this is where now you want to set a proper stop loss. And to do that, okay, we will go with a tool called the average true range indicator. So just go to indicator, look for ATR, pull out I like to go with a 20 period ATR because there's 20 trading days in a month. I like to go with SMA because I'm a simple man with a simple needs. Okay, so how do we use this indicator? So if you recall, in the earlier slide presentation, I said that, you want to set your stop loss at a level which invalidates your trading setup. And you saw that, there's actually some buffer you give, right, for the price to break below support before you exit the trade, because you don't want to set your stop loss just smack under support like this. In this case, let's say you just set it just below this lows, because what could happen is that the price could just come down lower, bounce into support, and then continue higher from there. And then if you set your stop loss just below it, you get stopped up prematurely. You don't want that. So give it some buffer. And to know how much buffer to give, right, this is where the tool, right, like the average true range comes into play. So let me just explain to you how this works. So at the average true range value right now, it's about $15.06, as you see over here. So what this means, right, is that historically this stock fiber over the last 20 days, it has moved an average of $15.06 on each day. The range of the day between the highs and lows is about $15. So when you set your stop loss, what you want to do is to then first and foremost find out what's the low of this support, what's the low of this swing low. So let me just see. Let's say the low in this case is about $129.21. Okay, for the low of this this candle, 129.21. So you take $129.21 minus $15.06, which is 1 ATR. So I got a calculator with me, 129.21 minus 15.06. And it gives me a value of about $114.20. So if I were to plot my stop loss, it will be somewhere about here. Okay, that's where my stop loss will be. And in this case, I'll just go with a red color to signify stop loss. There you have it. So this is where my stop loss will be for this particular setup or trade, if you want to call it. So from this low, from here, this low to this point is 1 ATR. And the 1 ATR value is about $15.06 as shown over here. So this is the buffer that we give for our stop loss, just in case the price spiked through below support and then reverse from there. So we have some buffer, right, to give us this so-called protection. So let's have a look at, I don't think we need to look at another example, because later in the trading example section, we'll go through this once again. So now next thing that we want to talk about is, where do you exit your trade? Okay, so let's have a look at this chart over here. So let's say, for whatever reason, let's say, price has come into this area of swing low support, had this price rejection. Let's say you buy, you go long. So now where do you exit your trade? So imagine now that you're long, right? You're in this long trade. Where do you think opposing pressure will step in? So recall, right? We mentioned that, opposing pressure, if you have forgot, right? You want to exit your trade before opposing pressure steps in. And it's usually before resistance, before swing high. So in this case, you can see that this is a nearest swing high. So you want to exit your trade before this swing high over here. You don't want to have your target above this highs. No doubt, right? In this case, you would have, made a profit. But again, what if the price doesn't retest this high? What if it just comes up higher and then reverse from there? Then you will have, watch your winner become loser. So this is why we want to set our target before the nearest swing high or before resistance. So now that you have understood what I've shared with you, let's have a look at some examples, right, to take into account the different concepts that we have spoke about earlier. So first, to start with, okay, first example, I'll share with you winners and losers so you kind of know what to expect when you're doing this on your own. So first one is Kirkland. So if you look at this, okay, this is remember what I shared with you, the few things to look for is number one, the trend. So let's just assume that the overall broad-based market is in an uptrend, right, to make things easier. So the next thing that we're looking for is to make sure that the individual stock is in an uptrend. So we overlay with the 200 period moving average, as you see over here. Price is above it, great, we can look for buying opportunities. So in this case, did the stock come towards an area of value? And what you can see that, yes, it did come into this area of value, this area of support. And not only that, right, it has the confluence of the 50-day moving average as well. Pretty sweet, right? When you have area of support having a confluence of the 50-day moving average, and that 50-day moving average, is respected by the market, like, it tested once, twice, three times, right? And here, a fourth time, right? You can see that this really is it really sweetens the deal a lot. So yes, the stock is at this area of value. In this case, it's let's call it just S plus M, okay, SM. And the third thing, do we have an entry trigger? So in this case, if you look at this, remember I said that, when we talk about candlestick patterns, right, there's no point trying to memorize each individual pattern, because in the real world of trading, the pattern might have slight variations to it. So in this case, we have something that looks like a hammer, but only difference is that it closed slightly lower for the day. But still, I consider this a price rejection, a rejection of lower prices. And it's perfectly, to me, it's a valid setup, and you can look to buy on the next day open. So let's say the next day in market open at this price. It opened here. So you can go long on the next day open. Stop loss, remember, we like to set it 1 ATR below the low. So let's say this is the nearest, this is the low of support. We set it 1 ATR below it. So again, let's just pull out our ATR indicator. Just full ATR. I like to go with a 20 period. Oh, it's already there. So I'm just going to close this. So over here, so you can see that the current ATR value is about $2.90, as shown over here. So what you'll do is you find out what's the lowest price point and minus 1 ATR. So in this case, the lowest price point for this candle, it's about $20.69. Okay, so $20.69, you minus, let's say, $2.90, $20.69. You minus, okay, in this case, the current ATR is 286. You minus 286. It's about $17.83. So you just pull out your stop loss tool. I mean, this is a horizontal line, and your stop loss will be at $17.83. So in this case, $17.83. Click OK. So this is where your stop loss will be. Your stop loss, right? So let's say if you enter on next day open, which is this candle here, stop loss is at this red line. So now what about your target? You already have defined, right, your exit in case the market moves against you. Now, what if the market moves in your favor? Where will you exit your trade? So let's say this one here. I can't see this. Right, this is the rate is stop loss. This black line here is entry. Where would you exit if the market moves in your favor? So remember, from a swing trading perspective, we want to exit our trade before opposing pressure steps in, and you can identify that this is the recent swing high. So sellers might come in at around $32 price point, exit selling pressure in this market. So to me, it makes sense to have your target profit before $32, maybe somewhere about here in this case. Okay, so let's see. In this case, clearly this is a winning trade, as the market has rallied higher and pretty much would have hit your target. So this is how the concepts which I've shared with you how it works. So let's have a look at a few more examples before we kind of sum it up. So Etsy is another one over here. You can see in this case stock is in an uptrend, right? It came into this area of value, this area of support. I believe it has the confluence of the 50-day moving average as well. As you can see, it did break below it. But remember, one thing to point out is when you are identifying your areas of value, right? Remember, it's an area on your chart, not a single line. So in this case, the 50-day moving average, notice how the price, tends to come in towards this area of value, then hit higher, breaks below it, hit higher. In this case, it breaks below it and then hit higher as well. So again, you have to expect this, right? In your own trading, we are dealing with an area of value, not a line on the chart. So in this case, you can see, again, we have the number trend, this one. Trend, that's one. Trend is uptrend. Number two, we have the area of value at support. And number three, our entry trigger. In this case, we have something that looks like a hammer. Again, it closed slightly lower for the day, but I would say this is bullish because it shows you rejection of lower prices. Look how much the price at one point in time, it was trading near these lows, only to get overwhelmed by the buyers to reverse and close near the opening price of the day. So I would say this is a rejection of lower prices. So you can call this I won't call this I would say a hammer, close to a hammer. Let's call it a ham then. Ham is close to a hammer. And you enter on the next day open. Okay, so next day open at this price point over here. Okay, now what about stop loss? Again, we know it's 1 ATR below this low, so I'm going to guess it's probably somewhere about here. It's your stop loss. As for target, we want to exit before opposing pressure steps in. And if you look at this is the recent swing high. We want to exit around the $240 price point, somewhere about there. Okay. Next example, we can have a look at Upwork. Okay, we talked about that earlier, but we can look at this example as well. So Upwork, again, this one here, same concept. Stock is in an uptrend, as you can see over here. It's definitely above the 200-day moving average. Area of value is this over here, this swing low support, and then number three, we have this. Now, this doesn't look like a ham. It looks like a hammer. Right? This is a hammer. Okay, so we can enter on the next day open. If this has a valid entry trigger. So next day open, we enter on the opening price here. Stop loss again, 1 ATR below this lows. Target again just before this most recent swing high. And let's have a look at one more example. In this case, it's actually a losing trade, but I just want to prepare you to the reality of trading. It's not not always going to be winner. There will be losers along the way. So in this case, you can see that this is Zoom. In fact, I really like this setup a lot. I thought it's really a good, legitimate setup. Number one, uptrend. Area of value, you have this swing low plus 50-day moving average. You can see over here. Actually, it's an area of support, right? Support tested once, twice over here with the 50-day moving average. So we have this area of value, or rather two area of value. And then we have this entry trigger. In this case, we have a gap up. You can see over here. This candle here, it gap up and close near the highs of the day. So that's nice as well. So over here will be our entry trigger. Enter on the next day open, which is somewhere here. Stop loss will be 1 ATR below this lows, probably somewhere here. And your target, right, just before the most recent swing high, possibly somewhere about here is your target. So again, in this case, the trade didn't quite work out. It pretty much collapsed and you got stopped out. So that's pretty much it, right? So those are a few examples to share with you, so you know what to expect, when you're doing this on your own. And now the question is, hey Rayner, there are like thousands of stocks out there in the US stock markets. How do we find such trading opportunities, right? Every chart that you pick is all in an uptrend, Rayner. Do I need to have some cheat code to find a way to it? So yeah, the cheat code is this. How do you actually quickly scan for trading opportunities? And the best part, yeah, you don't need any software tools or any paid scanners. I'm going to share with you how to do it. So the way you're going to do it is you go to this website called Finviz, right? It's just go finviz.com. I'll just walk you through so you can see how this works. Okay, so when you go to the website Finviz, it looks something like this. And you go click on screener. So I'm going to walk you through step by step. So on this screener page, there are three things that you want to look for. So first thing you want to look for is the market cap of the stock. I don't want to be trading, micro stocks or, penny stocks and stuff like that. I want to be trading the more liquid stocks. So I use it a filter as the mid, right? Anything above $2 billion. I am perfectly comfortable trading it. The next filter that you want to use is under the technical part. Okay, the first one was a descriptive filter. Now the technical filter. You want to make sure that the 52-week high-low, which is this one over here, you want the stock, right, to be 5% or more below the high. So this means that the stock is now currently making a pullback, right, away from the 52-week high, at least 5% or more. And the final thing that you want is your performance, right? You don't just want any Tom, Dick, Harry stock. Remember, we want to be trading stocks which are in an uptrend. We want to be trading the strongest stocks. So what you can do is to pretty much look for performance. Any stocks, right, that for the year has increased more than 200%, right? You want to be focusing on this stock. So again, this parameter here can be a little bit subjective because it depends on the current nature of the market. If let's say the market now is in an insanely strong bull market, then you want to be more picky with your setups. You can maybe choose only stocks that has increased more than 500% over the past 1 year. But if the market is a bit choppy, up and down, not really going anywhere, you can adjust your parameter accordingly. But in this case, right now, I'm going to go with stocks, right, that has increased, right, at least, right, 300% over the past 1 year. Okay. And once you've done it, ta-da, what's going to do is that it will spit out to you all the stocks. So let me just share with you how to actually use this. So we go to company. We want to see the, okay, can't remember this. What is it? Technical performance. Okay. Click performance. So once you have performance, you can see the strongest stocks, right, rank all the way to the lowest one. So in this case, you have just 4 or 5 fields to look at. So in this case, let me see. You want to rank the stocks from the strongest to the weakest. And what you want to do is to click. You see this one over here? You click on this. Now it's the bottom one right at the top. So this stock, Sono, has increased 301%. If you click it one more time, it has ranked the strongest one, Mara, right at the top, right? 6,840%. So it ranks from the strongest all the way down to the weakest ones. So what's there left to do? Very simple. If you can just, go to this tool over here, you look at Mara, it pops up a little bit of chart, a glimpse of a chart that you can see what the chart is like. So if you look at this one glimpse, right, you can know instantly, is this stock in an uptrend or not? If it's in an uptrend, you can add it to your watch list. If it's not, then just, move on to the next one. Look at Riot. So seems to be an uptrend, fair enough. APPS, we had this earlier. I just want to show you a better example. If you look at this OSTK, this one clearly is not in an uptrend. So move on, don't bother adding this to your watch list. This one, bad example, don't add it to your watch list because this stock is not in an uptrend. Based on the chart that you see, the chart that pop up, you can see that it's not in an uptrend. Next one, SI, not too bad, maybe might pass. We can add this to our watch list. EXPI, this stock is pretty much looking like in a downtrend or range. Let's, leave it. So what you want to do is, all these potential stocks which are in an uptrend, add it to your own watch list. And this is actually what I do myself. You can see over here, I have a watch list of stocks, which are pretty much, all over here. Okay, and out of this watch list are pretty much stocks, right, which are in an uptrend. Let me show you. Kirkland. Stocks in an uptrend. APPS, GRWG, IBRX, PEN. Okay, so once you have all these stocks in your watch list which are in an uptrend, what's next? Well, the only thing that's left to do is to let the market come to you, let it come to your area of value. That's all you need to, look for the upcoming week. So in this case, let me just share with you a few trading opportunities that I'm looking at for this coming week. And again, it's using the same concepts, the same strategies that I've shared with you. It's all from this free scanner over here. Okay, I've just spent some time on the weekend, and you can pretty much get all this potential trading setups worth trading. So let me share with you. Let's have a look at this. Right. So I have prepared a few. HRI. This is one upcoming trading setup. Okay, so if you just overlay the 50-day moving average, you can see this is a stock in an uptrend. How did I find this stock, HRI? If you go to the scanner, there it is, number 54, HRI. This is not magic. This is not voodoo. This is a step-by-step process, right, to make your trading life easier and hopefully, get you trading results. Okay, I'm not holding anything back. So there you have it, right, HRI. So what I'm looking for this stock for this upcoming week is, again, this is the area of value worth looking at, and this is the 50-day moving average that also this market that seems to be respecting it, right? Tested a number of times, almost once, twice, 3 times, 4 times, 5 times, possibly a 5th time over here, and we have this confluence of this swing low over here. So what I'm looking for this coming week or the next few weeks is for the price to come into this area of value and reject it, right? It could be in the form of a hammer, a bullish engulfing pattern. The stronger the price rejection, the better. Then I will set my stop loss 1 ATR below the swing low, as what I've just shared with you. As for targets, right, I usually like to, take partial profits before the swing high and to ride the remaining half, right, to ride the trend. So this, again, right, it's not a topic to cover in today's webinar because I'm actually, short of time. But again, you can actually look for all this resource materials on my website or, my book, which you can read. So anyway, moving on, another example, Sono. So this one over here, Sono, you can see same concept. Stock is in an uptrend. Overlay with the 50-day moving average. You have this area that's worth trading from around the $35 price point, near this area of support, near this 50-day moving average, which is also acting as a confluence. So looking for a bullish price rejection, for the price comes in, quickly reject it, close up higher, looking to enter on the next candle open. Stop loss can go 1 ATR below this lows. Target just before the swing high. I'll just walk you through a few examples before we call it a session. Next one over here, FCX, same concept. This one actually here, there's a valid trading setup. And one thing to point out, if you're going to take this trading setup, whether you make money, whether you lose money, it's all on you. It's all on your responsibility. I will not be responsible for it. All right, you are a wise adult. You can be accountable, and all this is just for educational purposes. So you can see over here for this stock, there's actually a valid trading setup right now. Price came into this area of support, and then on Friday it gapped and closed right near, I'll say near the middle of the range. But I'll see it's slightly bullish as it has a green color annotation to it. Closes, bullishly. And it has, rejected this area of support. So what you can do is come Monday, you can look to enter on the next candle open. Stop loss can go 1 ATR again below this low somewhere here. Your first possible target can go just around before the $38 price point. So this is a free pot. Another one. This is a Caesars Entertainment. So again, same thing. We have a valid trading setup. You can see the price came into this swing low. 50-day moving average confluence plus this swing low. We have a bullish engulfing pattern. This one was on a Thursday. Friday closed slightly bearishly, but still, hey, it's a valid trading setup that you can take. Can enter on Monday. Stop loss 1 ATR below this lows. Target just before this swing high. And what I've shared with you, again, it's not just applicable to stock trading. You can apply to Forex, as well, or futures. So I'm going to share with you a few Forex pairs so you can see what I mean. So next one, dollar yen. In this case, we'll have a look at the 8-hour time frame. You can see that this market is in an uptrend. This is the area of value that I'm looking at for a possible, retest. Bullish price rejection. We're looking to enter our next candle open. Stop loss can go 1 ATR below this lows. Possible target before this swing high. Another example, euro against the British pound. Same concept. This is the 8-hour time frame. You can see that this market now is in a downtrend. So again, this is the area of value. Right, looking for a retest of this resistance, can get a bearish price rejection, can look to sell on the next candle open. So really the strategies, the concepts that you've just learned can be applied to the other markets as well. So don't forget, the trend, the area of value, the entry trigger, the stop loss and the targets which I've shared with you earlier.
Now, as a quick recap, here's what you've learned today. Number one, it's far easier to make money from stocks, right, when the stock is trending higher, right, and not when it's in a downtrend. So in other words, right, you want to be buying stocks in an uptrend, not a downtrend. Number two, a trend filter can improve your returns and reduce your risk. Number three, you must have an edge, right, when trading the markets. And finally, number four, I explained this one in depth, the TAY formula. If you haven't realized, TAY stands for trend. Number one is to look for trending markets. Number two, look to trade from an area of value like support, swing low, 50-day moving average. Number three, wait for a valid entry trigger to time your entry. Could be things like, bullish reversal candlestick patterns. And number four, exits, right? Know when to exit, right, if the market moves against you, otherwise known as your stop loss, and know when to exit if the market moves in your favor, otherwise known as your take profit level. Okay, so now if you want to learn more about trading, right, trading in such a manner, then I recommend you to get a copy of this book called Price Action Trading Secrets. I will put the link below, or you can actually enter this link over here. And this is actually a 140-page color trading book, right, that will walk you through, right, price action trading strategies that work. So what we've covered is just a fraction, right, of price action trading. We can go more in depth about support resistance, how to draw them, more candlestick patterns, explaining you breakout trades, reversal trades, and much more. And if you get a copy of this book here today, by the way, it's a 140-page color physical trading book, I will also include a few bonuses for you. So for example, bonus number one, you will get a digital copy, a PDF version of this Price Action Trading Secrets book that will be sent to you immediately. Number two, you will get this position sizing calculator, right, that you can use to know how much units of stocks to buy, so you never blow up another trading account, so you can manage your risk like a pro. And finally, number three, right, I will share with you this webinar. It's called Part-Time Secrets Webinar, Part-Time Trading Secrets, and you will learn, right, how as a part-time trader you can still find time, right, to trade the markets consistently and profitably. So all this, right, bonuses comes to you for free when you invest in Price Action Trading Secrets book today. So just come to this page, just click any of this blue button, and you'll be brought out to the checkout page here below. Just fill up and you can get started immediately. So of course, it comes with a 60 days money back guarantee. If you find it's not for you, we'll gladly refund you back your money, and you can still keep the book, right? So the book is $18.90 for international customers. For those of you on the US, it will be $12.90. So again, the link here is Price Action Trading Secrets. I will put the link below this video, and you can get started with this immediately. So with that said, I wish you good luck, good trading. I will talk to you soon.